Hi everybody, and welcome back to video number 4 in merchandising inventories. And when we left off, we were looking at the differences between periodic inventory and perpetual inventory. And I think you're going to find there are some fairly significant differences in the way we do our adjusting and closing entries. And again, you're welcome to use this as your notes for the upcoming exam. But here, just keep in mind under a periodic inventory, we don't know what our inventory amounts are. So we can't do some of the things that we do under perpetual. But it all comes out in the wash if it's done correctly. So here, we show that there's no cost of goods sold impact here. Here, the differences between purchases and cost of goods sold. And then our closing entries, quite a bit different here under periodic. Here we have our merchandise inventory, purchase discounts, purchase returns and allowances, and our income summary amounts are different, as are the ones for the cost and expenses. Here we have some beginning inventory that we adjust, our purchases, our transportation in, whereas we only have the one cost of goods sold for perpetual. You're just going to have to study this sheet a little bit before this makes sense to you. But I think once you get the feeling for this, it'll start to make sense. Okay. Under Appendix 4 Bravo here, we're going to prepare some adjustments per the revenue recognition rules, the new revenue recognition rules. And I won't spend a great deal of time on this, but if you're an accounting major, you probably want to make sure you understand this too. But here, our adjusting entries are required to estimate the sales discounts for a current period sales expected to be taken in future periods. That's an estimate, of course. And it has this unadjusted accounts receivable balance here of $11,250, but the allowance for sales discount is zero. So we have $2,500 of receivables that are within the 2% discount range. So we're going to expect that those buyers are going to take $50 in future period discounts, computed by multiplying 2,500, that's the receivable balance, times 2%. And we book it by debiting sales discounts here and crediting an allowance for sales discounts. So how does that little beauty look on the balance sheet? Well, you can see that the allowance for sales discounts does show on the balance sheet, but we reflect it in the income statement as a sales discount here at $6,300. Okay, little sophisticated there, but the idea is to properly report our net sales at the net realizable amount. Okay, so here we expect to have returns and allowances. I would hate to be in that situation where I'm expecting returns and allowances, but nevertheless, we have a revenue side adjusting entry. We estimate that future sales refunds are going to be $1,200. And the unadjusted balance in the sales refund payable is $300 credit. So the adjusting entry is going to be a $900 amount that updates that sales refund payable by $900. Okay. And then the cost side, that was the revenue side we just did. The cost side here, we estimate that future inventory returns are going to be $500. The unadjusted balance in inventory returns estimated is a $200 debit. So our adjusting entry, therefore, is going to be a $300 update to the inventory returns estimated. So you can see that that's just what we've done here with the debit to inventory returns estimated and a credit to cost of goods sold. Okay. That assumes naturally that that inventory is returned to inventory. Now, gross method and net method. We looked at the gross method in the PowerPoint so far, where we purchased merchandise and then we reflected the purchase discounts as they are earned or incurred. But if we do it the net method way, we're going to show this right away that we expect that we're going to be purchasing this and expecting to pay that $10 discount. So that discount shown here is merchandise inventory. That's going to reduce our inventory because we're getting that $10. Now, if we use the net method, you can see here that we use an account called discounts lost to make the balances all work. An interesting method. By the way, I don't ask you much on the net method versus the gross method other than just basic conceptual understanding. And so under the perpetual method, we're going to have differences here as we sell things. Under the net method, we show the receivable at the net amount we expect to receive and the cash that we expect to receive. But our interest revenue is going to be $10 if they pay outside the discount period. Okay, that wraps up chapter 4. And when we come back, we'll take a look at chapter 5. Until then, bye for now.